What up, everyone? Welcome back to the channel. Today, we are talking about sleep well at night portfolio, swan stocks, if you will. We've seen AI hype turn into AI reality. We don't know exactly what the Fed is going to be doing with Jerome Powell stepping down and the new guy coming in. So you need to buckle up because 2026 volatility is here to stay. But if you want to stop checking your brokerage app every 10 minutes and actually enjoy your life, you need businesses that are basically toll booths for the modern world. If you're new here, my name is Nick. I am a former financial advisor. I'm the author of the award-winning book, The Quick Start Guide to Investing. And at 42, I quit my job so that I could live life on my own terms. My family of four lives off investments just like these, as well as some weekly options trades that I do. If you want to find out more ways to generate income, to find financial freedom, and break away from your 9 to 5, hit that like and subscribe for more videos like this. Today, I'm doing 3 no-brainer picks that I'm holding through all the noise. Amazon, Google, and Broadcom. Let's dive in.
Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. Let's get into it.
First up is the king of retail and the backbone of the internet. Why is Amazon a swan stock? They got a forward PE ratio sitting right at 28. For context, they used to be 80 to 100 back in the day. They're on a heavy earnings trend. We're seeing massive expansion here right now. Amazon's shift to a regionalized fulfillment model has slashed costs, and they're forecasting a massive $200 billion in capex for 2026. Amazon isn't just a store, it's an infrastructure play. There's 4 reasons why you can sleep easy owning Amazon. Number 1, AWS, the Amazon Web Services. It's the landlord of the internet. As every company on Earth integrates to AI, they need AWS's computing power. Speaking of AI, Amazon is an early investor into the hottest AI model right now, Anthropic, and I'm going to hit on that in just a second. Number 3, you've got advertising, and this is the secret weapon for Amazon. Amazon's ad business is growing faster than Google's or Meta's. And that's a big deal because people, when they're on Amazon, they're there to buy and they see ads and they're making money off of those ads just as we are spending money by clicking on those ads. Number 4, you've got prime stickiness. Once you're in the ecosystem, you don't really leave. Now, let's talk about the Amazon and Anthropic connection. The connection between the two is bigger than most people realize. It's the most important moats in the AI space right now. Think of it as a massive multi-billion-dollar handshake where both of the companies are getting exactly what they want, and they're going to dominate. So here's the breakdown. They're linked in 2026 just like this. Amazon has moved past its initial $4 billion investment and has now committed a total of $8 billion to Anthropic. Amazon remains a minority investor, but this is one of the largest corporate venture investments in history. So just as Microsoft is tethered to OpenAI, Amazon has secured Anthropic in its premier partner to ensure that they aren't left behind in the large language model race. So this isn't just about cash. It's about infrastructure. Under their agreement, AWS is Anthropic's primary cloud provider. Anthropic runs its mission-critical workloads, like training the latest Claude models, on AWS servers. This creates a circular economy. Amazon gives Anthropic money, and Anthropic spends a huge chunk of that money right back onto Amazon's cloud services. Seems a little cyclical, but it's good for Amazon as long as it doesn't turn into the whole Microsoft situation. Anyway, this is the part most retail investors miss. It is a huge win for Broadcom also and Amazon because of their internal hardware teams. You see, Anthropic doesn't just use standard NVIDIA chips. They are specifically collaborating with Amazon to build and train models on Amazon's custom AI chips. So they've got vertical integration. By helping Anthropic optimize the code for Amazon's own silicon, Amazon reduces its reliance on expensive third-party hardware and boosts its own profit margins. Pretty good. If you're a business owner in 2026 and you want to use Claude or Claude 5 models, the easiest and most secure way to do it is through Amazon's Bedrock. You've got exclusive features. Because of this tight bond, AWS customers often get first-look access to customization and fine-tuning features that aren't necessarily available for Claude elsewhere. And then you've got big players like Pfizer and Delta that are using Claude specifically because it lives inside the AWS environment. They already trust this environment, so they're willing to work with Anthropic because of the AWS connection. For my portfolio, with Amazon in the low 200s, this is a no-brainer. If you look at a chart, every time Amazon consolidates like this for a long time, we see a massive move to the upside in the future. And I'm adding on any dips to my already decent sized Amazon position. Okay, number 2, let's talk about Alphabet. Either Google, GOOG, or GOOGL. I don't think it necessarily matters, although GL has more liquidity, but that only depends on if you're doing day trade options. So, Alphabet, the AI underdog, that really isn't. We're talking about Alphabet because remember in 2024, everyone said Google was behind in AI. Well, that narrative aged like warm milk. You've got a forward PE ratio that's currently trading at 27. This is remarkably reasonable for a company that effectively owns the world's information. Their earnings are just as good. Alphabet just extended its 2026 rally with institutional investors piling into net call options. They're seeing revenue grow and accelerate because AI didn't kill search, it enhanced search. Google has this moat that basically seems like it's miles wide. So let's talk about the 3 reasons why you can sleep well at night while owning Google. Search and YouTube. YouTube is essentially TV for the Gen Z and Alpha generations. It is an attention monopoly. Number 2, you've got Google Cloud. Finally, a massive profit driver for the 3rd largest cloud provider, and it's scaling rapidly as businesses move their data to train their own AI models onto Google. And then finally, you've got Gemini integration. By baking AI into every doc, every sheet, every search, they've made software indispensable from AI. So looking at the charts, Google is primed for a move higher, and I personally sold some S&P 500 ETF, and I put that money into Google because I think Google has more upside than the broader market does here. I love Google for the future. Finally, we have Broadcom. If Amazon and Google are the buildings of the internet, well, Broadcom is literally the steel and the plumbing. It holds everything together. Their PE ratio is 30 to 35, but if you talk to analysts, they think that it's worth paying for the quality here. Just because a company is cheap doesn't mean a company is good. Broadcom and really their biggest competitors are proving that they are the quality here, and you're willing to pay a little bit more on the price to earnings. But analysts are looking for an EPS of over 7 this year. They just secured a $21 billion order from Google for custom TPU accelerators, and this is insane demand that Broadcom has seen. Broadcom is the ultimate pick and shovel play with AI. And here's 3 reasons why you can sleep well owning Broadcom. They have custom silicon. They don't just make generic chips. They make the custom AI chips for companies like Google and for Meta. Number 2, you can't build a data center without Broadcom's switching and routing technology. Period. You just can't do it. Then you've got their VMware strategy. The acquisition of VMware is now fully integrated, providing a massive stream of high-margin software subscriptions and revenue. Personally, Broadcom for me was a trade that I look back in 2025 with some regret. I got in real cheap and I started running the wheel and I got assigned and had to sell my shares, and then Broadcom took off and they never looked back. So when it started dipping into the 300s, I lost it at like $215, I think, last year. But when it started dipping into the 300s again in February, I started to dollar cost my way back into Broadcom. I was hoping for a bigger move down, but it seems that Broadcom has now found some support and it is back to the races. Look, the bottom line is that these, to me, are no-brainers because they aren't betting if the future happens. They are the future. Amazon owns delivery in the cloud. Google owns information and video. Broadcom owns hardware that makes everything run. When you own the infrastructure, you don't have to worry about which individual app or which AI startup is going to win. You win either way. Drop a comment below. Which of these 3 is your must-have for 2026? Are you team Amazon, Google, or Broadcom? I'll be jumping in the comments to chat with you guys. And don't forget to hit that like and subscribe button if you found this helpful for more videos just like this each week. We'll see you in the next one.